Hello and welcome to On the Mark Financial Literacy with Mark Zimmern. We're excited to offer you a multi-part series on what you can do to avoid surprises and adjust or manipulate your income now that we're in Q4 tax planning season. Q4 is also the time when businesses may give their employees an end-of-year discretionary monetary bonus, so we'll cover taxation on that as well. We hope you find this multi-part series informative and helpful. We have Mark with us today. How are you this afternoon, Mark?
I'm doing wonderful. It's past October 15th, so it's great.
It is.
October 15th, for those that don't know, is the final due date for all returns, which is the personal return. So as an accountant, we live with so many dates, so I'm happy it's past October 15th.
Another deadline in the rearview mirror.
That is correct. So as the leaves change color, we start thinking about taxes. At least we do. Most people don't like it's April 15th and people don't want to think about taxes. But so the thing that we're trying to do here with our clients, and I'll incorporate individuals and businesses, is we're just trying to have no surprises, right? I really think that too many people wait until they get their taxes done to find out whether or not they owe money or get a refund, and their mood and or their whole demeanor is all bent upon that. I mean, there's been many years where when clients owe money, I say, well, I guess I really sucked this year. And when clients don't owe money or they're getting a refund, I'm a hero. But that's not really, I don't really have any say in that other than doing a competent job in the preparation. So for individuals, what I would recommend is I would recommend that you, when I say individuals, I'm talking about non-business owners who are maybe W-2 employees, that maybe you take a look at, pull a pay stub for yourself and maybe for your spouse and try and factor out what your income is going to be for the year and what your withholding is going to be for the year. And then take a look at that against your tax return for last year. And that should give you a pretty good idea of where you are. I mean, certainly if you have a tax professional, they'll be happy to do a tax projection for you. But if you don't, or you don't want to spend the money, the easiest way to do it is to just try and figure out where you were in relation to last year. And taxes really haven't changed that much. So if your income and your withholding is pretty much the same or within a reasonable amount of not being materially higher or lower, and your other expenses and income are the same, then you should be okay. Or you should be similar to what you were last year. But, I guess what I'm saying is empower yourself to look at it and not be, and I don't mean it's don't be a victim of the result. Because I will say that in our accounting practice, we do tax projections for nearly every business client. And then during tax season, I do their taxes, right? And the first thing I do before I call them or send them results is pull out the tax projection to see how close I was. Because often our clients don't even remember what I told them. But if I can show them what I told them, then it's not as much of a surprise as if I didn't do it at all.
All right, so no surprises.
And my entire practice is built on no surprises. And I really feel from a financial literacy point of view that, and we talk about this, and this is a theme that's going to run, we're trying to empower our audience to take control of their financial life and not to be subject to things that they feel are out of their control. And I think that people feel a lot better if they take that control, or at least they try to do what they can to implement that control.
So what would be an example of some expenses or purchases or changes to one's financial picture or financial portfolio that an individual or perhaps even a small business owner should share with their accountant, maybe even prior to making such a decision that will have an impact in one direction or the other upon their taxable income for that year that may differ from the previous year?
So one of the things for individuals, another thing we would look at is capital gains and losses, right? So people tend, and I'm including financial advisors as well, they tend to cash in profits, but not cash in losses because they feel like, well, I bought it and it'll come back. But there's a term we use called harvesting losses. So maybe if you've had some gains through the year and you have some stocks that may be underwater, meaning less than what you paid for them, but you're still hopeful about the industry, you can sell those stocks to net against your profit so you don't pay the tax. And there is a rule that you're not allowed to buy back a stock for which you sold at a loss within 30 days without doing what's called a wash sale, which means you don't get credit for the loss. But you can buy a similar stock in the same industry. So I'll give you an example. Let's say you own AT&T stock and you have a loss. You could sell it and buy a Verizon stock. Or you could sell one mutual fund and buy a different one, even if it has similar holdings. You just can't buy the same thing back and forth. But that's something you can talk to your financial advisor. And again, it's just a matter of trying to control the taxes. Taxes, what do they say? Death and taxes are what you get. But what we're trying to talk about here is how to manipulate in some positive manner to take control of it, recognizing what you're doing may have an effect in the future. Okay. Mm-hmm. And then from a business point of view, the economic result of a transaction is taxes, not the reason to do it or not do it. So the first thing I always tell clients is, if you make more than $500,000 a year, and I bet there's very few people listening to this that make that, okay, you're in a 35% tax bracket. So that's the highest income tax bracket we have. For every dollar you spend, it still costs you 65 cents if you can deduct it. So if I go and spend $1,000 to save $350 in taxes, it still costs me $650. So the reason to do something is never for taxes, but the reason to manipulate when you do it is for taxes. So quite often, from a business point of view, we do a lot of our tax projections for our clients in December from November numbers, but basically you can do your own tax planning or do it with your professional once you have a handle on what your income is going to be. Normally, expenses are more predictable in a business than income is. Like, I'm going to incur this or I'm going to buy that, but you don't know who's going to pay you and how fast. And the other thing to note is most small businesses are what's known as cash basis and not accrual. And just as a simple lesson, cash basis taxpayers, you recognize your revenue when you receive it, when you get a check or an ACH, and you recognize your expenses when you pay them, when you write the check or submit the invoice online. In accrual accounting, you recognize your revenue when you earn it, regardless of when you bill it and regardless of when they pay. And you incur expenses you have an expense when you incur the expense, not when you get the bill. So if I went today and I had a plumber work on something and they sent me a bill 2 weeks from now, let's just say that's next year, it would be an expense this year. Mm-hmm. But for cash basis, if I paid it next year, it would be an expense next year. Okay.
So Mark, there are some expenses that a small business owner might consider paying at end of year, right? And a couple different categories. They may fall under general operating expenses, investment and asset purchases. There are a couple different categories. Let's start talking about some of them. And you have a general principle that you follow regarding when you might decide that it makes potential sense to prepay in 2025. And what is that general principle?
Well, first of all, it's going to be whether or not you were going to buy it anyway, right? So, we already mentioned, it's 35 cents and 65 cents, right? So it's going to cost. So if we weren't going to buy it anyway, then please don't spend the money. The question of timing then becomes, so if you have an opportunity to, right now, Windows 10's dead and Windows 11 and some computers can't be upgraded. So if you're going to buy a bunch of computers, it might be advantageous to buy them in 25 so you can deduct them in 26. Part of the bill that was passed this year restored what's called the 100% bonus depreciation. We had that during COVID. It started to phase out. I think last year it was 60%. This year it's back to 100%. So basically there's nothing you can't buy that's depreciable other than buildings, okay, which are a different thing, that you can't write off in the year that you buy them. So if you want to go out and buy $10,000 or $20,000 worth of computers, you get to write off the $10,000 or $20,000.
Okay. So do you want to talk about the difference between, you're talking about bonus depreciation and a Section 179 deduction?
Well, really, Section 179 doesn't play in right now because if you have, so in the law is something called 100%. So 179 was the way to write off your asset in 1 year. Okay. Normally, an asset has a class life. So let's call it 5 years. That's a very normal for, fixtures, furniture, whatever. You basically get to write it off over 5 years. It's not 100%, but say 20% a year for 5 years, and you write it off. And then prior to this concept of bonus depreciation, there's this thing called 179 that people know about. You could elect to write off a certain number, and that number keeps going up, of equipment or those kind of assets in 1 year and not have to depreciate them over time. And then during COVID, this concept of bonus depreciation was introduced to help stimulate the economy, where for several years until about a year or two ago, it was 100% bonus depreciation, meaning that you bought something for $1,000, you could write off the $1,000. You didn't even have to consider writing it off over time. You didn't even have to consider 179. That has been restored under the bill that was passed in July. So in essence, we don't need to worry about 179 because we never get that far. You don't need to use it because you already can write everything off.
Okay.
And we're talking about, and when we're talking about writing off, we're talking about fixed assets. What's a fixed asset? I mean, something I hear from people always ask me, like, what's a fixed asset? So a fixed asset is something that has a useful life longer than one accounting period or 12 months. And the second part of that is materiality. So I can go buy a dollar pen, right? And my big pen lasts forever. I have ones from years ago. It's going to last longer. Do I have to depreciate it? Well, the answer would be yes, because it's going to last longer than a year. But the answer is no, because it's only 99 cents. So most businesses have what's called rules about depreciation. Sometimes $1,000, $1,500, $2,500 is a minimum before they will have to depreciate it. So if you bought something small, like you went out and bought a dock for your laptop and it's $110, that $110 would probably fall under the depreciation and you just write it off as a computer supply. Okay? So I'm just trying to explain the difference between a fixed asset you have to depreciate or bonus and something that would be an expense. And again, an accountant can help you with that.
Thank you for that.
Now,
what about rent and utilities?
Okay, so when we talk, so here's my other rule. So let's assume that you want to try and write off as much this year as possible. Okay? So you lower your income as much as you can in 2025. What are the conventions you can use? Well, first of all, you can accelerate the payment of your payables, right? So you may pay your bills as they come in and certain, I pay my electric bill in 4 weeks. I pay this in 3. You can accelerate all that into December, meaning that anything you would have normally, you already incurred, but you normally would pay in January, you pay in December to get the deduction. Then the next question is, well, what can I prepay? Is there anything I can prepay? And prepayments are allowed under the cash method of accounting, okay? But the rule that we dictate is that don't pay anything for which you have any concern of not getting the value of it later. So yes, can you prepay your rent? Yes. Can you prepay your utilities? Yes. Can you prepay your health insurance? Yes. Can you prepay your accountant? Definitely. Okay. I mean, if you want a deduction, you can pay me. But again, make sure, and I'm being a little tongue-in-cheek, but make sure you feel comfortable. You wouldn't prepay a vendor who's going to perform services unless you're comfortable that by paying them, you're not going to affect. Let's say you were going to design a logo for me, Monica, and I never worked with you before, and you're going to charge me $1,000 or $1,500. By me paying you, does that change the fact that you won't do the work on time, or it might not be? I mean, payments used for usually pay people when you're satisfied. If you're not sure you're going to be satisfied with the service or get the service, then no, it's not worth it, because again, you're saving 35 cents and still costing yourself 65 cents. And in my case, you don't have your logo.
Thanks, Mark. We're going to pause here and look forward to picking up where we left off next week. See you then. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.